All right, let's dive in. Today, we're getting into the nitty-gritty of the financial world. The actual rules, the key accounting standards that make sure the numbers companies show you are reliable, consistent, and, well, trustworthy.
So picture this. Your favorite team is on an absolute tear, having a fantastic season. But then right in the middle of it all, they just decide, you know what, from now on, every goal we score counts for double. How would you even compare their performance to last season or to any other team? You couldn't, right? It would be meaningless. Well, that's the exact same problem in finance. If a company can just change the rules of how they count their money whenever they feel like it, how can you really know if they're doing well? That's the core challenge we're talking about.
And that challenge, that very problem, is exactly why we have a global rulebook. You need to make sure everyone is playing the same game by the same rules. That's where international standards come in. They basically create a level playing field for every company and every investor out there.
Now, these standards are officially called IFRS. That stands for International Financial Reporting Standards. You can think of them as the official referee of the financial world. So what we're going to do is unpack 4 of these key rules to see how they solve some very specific, very common, and honestly, sometimes pretty surprising accounting problems.
Okay, first up, let's tackle a simple fact of life. Things change. Businesses evolve, and you know what? People make mistakes. So, how do you deal with that in the financial statements? The standard that gives us the framework for this is called IAS 8. It's the playbook for handling changes in policies, adjustments to estimates, and, crucially, how to fix errors from the past.
So let's start with what an accounting policy is. The best way to think about this is like the company's internal how-to guide for their own books. It's the specific rules they've decided to apply across the board. Like, for example, choosing to value their inventory on a first-in, first-out basis. And believe me, this is not a small decision. It has a direct impact on the cost of their sales, and that flows all the way down to their final profit.
Okay, but an accounting estimate is totally different. This isn't about changing the rule itself. It's about the judgment you use when you apply the rule. Think about a big piece of factory equipment. How long is that thing really going to last? 5 years? 10? Maybe 12? Estimating its useful life so you can calculate depreciation, that's an accounting estimate. It's a judgment call, an educated guess based on the best info you've got at the time.
And here is the absolutely crucial difference. It's all about how you treat a change to one of these. If a company changes a fundamental rule, an accounting policy, they have to go back in time and fix everything. It's applied retrospectively. This means they have to restate their past financial statements as if they had always used the new rule. This is a huge deal. It can literally change the story of their past performance. But if they're just refining a judgment call, an accounting estimate, like, hey, that machine's going to last 8 years, not 10, that's applied prospectively. The past is left alone. The change only impacts this year and all the years going forward. Big, big difference.
But what about when it's not a deliberate change at all? What if it was just a flat-out mistake, an error? Well, IAS 8 has that covered too. It calls them prior period errors. These are basically omissions or just plain wrong numbers that happen because someone failed to use good, reliable information that they actually had at the time.
And you can see exactly how this works right here. Take a look. A company found a $2.5 million error. Turns out some inventory they thought they still had back in 20XO had actually been sold. So on the left, you've got the original numbers they published. Now look at the restated numbers on the right. See the cost of sales for 20XO? Boom, it jumps up by that $2.5 million. And if you follow that impact all the way down to the bottom line, their net profit for that year drops from $13.8 million all the way down to $11.3 million. They literally had to go back and rewrite their own history to show the true picture. That's what a retrospective restatement looks like in the real world.
All right, so we've covered how to keep things consistent over time. But that leads to the next big question. How do you even figure out what something is worth in the first place? I mean, how do you put a credible, objective value on something that doesn't have a simple price tag? We're talking about stuff like a one-of-a-kind building or a really complex financial investment.
This is where another standard, IFRS 13, steps in. It defines this super important concept called fair value. The absolute easiest way to think about fair value is as the exit price. It's not what you paid for an asset. It's what you could get for it if you sold it, right now, today, in a normal transaction.
Now, to make sure companies aren't just pulling numbers out of thin air, IFRS 13 created what's called the fair value hierarchy. It's like a ladder of reliability. At the very top, you have Level 1. This is the gold standard. It's a quoted price in an active market for an identical asset. Think of a share of stock in a public company. Super reliable. Level 2 is for when you don't have that, but you can see prices for similar things. And then there's level 3, the bottom rung. This is where you have to use your own data and models because there's just no market data to look at. The rule is you have to use the highest, most reliable level you can, because the further down that ladder you go, especially to level 3, the more judgment is involved. And you can bet that's where investors are going to look the hardest.
Okay, so let's take this big idea of valuation and bring it back down to earth. Let's talk about one of the most common things a business owns. It's inventory. Now, inventory is so important it gets its own special standard, IAS 2. And the main rule for inventory is a perfect example of a core accounting idea, prudence. It's really simple. You value your inventory at what you paid for it, its cost, unless it's now worth less. So let's say you've got a warehouse full of last season's hot new gadget, and now nobody wants it. You can't pretend it's still worth what you paid. You have to write its value down to whatever you can realistically sell it for. You have to recognize that loss right away. This is so important because it stops companies from pretending their assets are worth more than they really are.
So that rule works great for boxes on a shelf. But what happens when your assets aren't just sitting there gathering dust? What happens when your assets are alive?
I mean, think about it for a second. A factory machine gets older, it wears out, it depreciates. But a forest? The trees are growing, becoming more valuable every single year. A herd of sheep is producing wool and expanding. The old rules just completely fall apart here. How on earth do you account for that?
Well, the answer is another special standard, IAS 41, which is all about agriculture. It deals with what accountants call biological assets. Yep, that's the official term for living animals and plants, covering everything from cattle and sheep to vineyards and forests. And this little journey here shows you exactly how it works. A living sheep on a farm, that's a biological asset, and it's covered by IAS 41. The moment you shear that sheep, the wool is called agricultural produce. It's still under IAS 41, but just at that point of harvest. But then, once you take that wool and process it into yarn, it's not a biological thing anymore. It's just inventory, and the accounting for it switches right over to the inventory standard, IAS 2. See how that works? And here's where it gets really interesting and kind of revolutionary. Biological assets are measured at their fair value, minus the cost to sell them. But here's the kicker. At the end of every single financial period, you have to remeasure them. And any change in that value, any gain you made because your forest grew or your herd got bigger, gets recognized as profit for that period. That means a farmer can show a profit even before they've sold a single thing because it reflects the economic reality of what's happening. Their assets are literally growing in value. So when you step back and look at all this, you see how these pieces fit together to build a pretty powerful system. You've got IAS 8 making sure the story is consistent over time. Then you have IFRS 13, IAS 2, and the really unique IAS 41 giving us solid rules for valuing everything from stocks to sheep. This whole framework is what makes it possible for an investor in, say, Tokyo, to look at a German car company and a Brazilian farm and actually compare them apples to apples. It really is the language of global business. In the end, these standards provide the rulebook, the framework that everyone's supposed to play by. But as we've seen, so much still boils down to judgment calls and estimates. And that leaves us with one final big question to think about. Where is the line? Where does sound professional judgment stop and so-called creative accounting begin? Something to chew on. Thanks for tuning in.